It's having an honest assessment of what they're good at and what they're not good at, right? Understanding what your strengths are as an investor, as a trader, and even more focused on what your weaknesses are. Making the very quick initial assessment. Is the price above or below the 21-day EMA? Is that sloping upwards or downwards? The 4 deadly sins you can make are buying too early, buying too late, selling too early, selling too late, right? Those are the 4 classic things we can do. I bet in your own trading, you can find 1 or 2 of those that you probably tend to do more often, and that will tell you very quickly where your biases are.
Hello, and welcome to the Trader's Journey for Investors Underground. In this episode, I'm excited to be joined by David Keller. David is the president and chief strategist at Sierra Alpha Research, a boutique research and coaching firm. He also leads the Market Misbehavior community of mindful investors. He's also the host of the Market Misbehavior podcast and the Chartist podcast. David's career and his work is vast, spanning work at Bloomberg, Fidelity, lectures at Brandeis University on the topics of technical analysis and behavioral finance, and he served as the president of the CMT Association, where he holds a designation of Chartered Market Technician, or CMT. It's my honor to introduce David Keller. Hello, David. Welcome to the show. Thank you for being here.
No, it's a pleasure, Anthony. Thanks so much for the invitation. I'm looking forward to it.
Yeah, absolutely. I'm really happy that we got a chance to connect. Turns out that we both share an interest and have lived in Ohio area. So it's really great to connect with you. I've been watching you online in your podcasts. So it's really cool. And I'm honored that you've agreed to come on and share your trading journey with the audience.
No, I'm happy to do it. And again, I appreciate what you're doing with the show. I wish you much success, and I hope we can have a good conversation for everyone.
Yeah, I'm very optimistic that we will, David. If it's okay with you, I love to start by just asking people, how did you first get interested in the stock market and the world of trading / investing?
No, I have what we would call a non-traditional path into the financial industry, I would say. So I studied music and psychology as an undergraduate at The Ohio State University. And in June of 2000, just before then, I had graduated. And honestly, my goal was to be a working musician. I'm a trumpet player and a singer. And so if you think the VIX or if you think cryptocurrencies are volatile, try being a working musician. Your income stream is sort of feast or famine. So I'd have an amazing 3-week stretch and then nothing for like 2 weeks. And it was absolutely brutal. So I looked for a job that would pay me consistently. That sounded fantastic. And I found a firm, a market data firm called Bloomberg in New York that loved, for some reason, to hire liberal arts majors. So they were really excited to bring on a music and psychology major. I somehow convinced them that was a great, proving ground for a market analyst. And they gave me a job. And what's so funny is I found very quickly that studying music and psychology somehow prepared me to be a pretty good technical analyst, I would say. The psychology one probably makes sense because I would argue what I do analyzing charts is just analyzing investor psychology. I'm trying to get inside the head of other traders. I'm trying to understand if they're nervous or excited or euphoric or desperate. And I would say a lot of charts are just ways of quantifying that changing sentiment and when investors, change, get nervous and when fear dominates their thinking. And then the music one's a little more of a stretch. And if anyone listening is a musician, I actually studied orchestral conducting, which is where you stand in front of an orchestra and you're trying to, get all of this group of 100 people to, have this experience together. And then you glance at an orchestral score, which is a page, a full page score, usually like 15 to 20 parts. And what I found is you're trained to look down at a piece of music and immediately look for patterns, right? You think about who has the melody, who has the harmony, who's playing together, who is sort of disagreeing, where's their tension. And then based on your knowledge of music history in that period, you sort of anticipate what's probably going to come next because you know the style and you know the structure. And when I first saw a chart with a bunch of technical indicators, it's like I'd been training for years for that, because you glance at a chart and you look at, convergence and divergence. You look at where the trends are, you look for disagreements, and you think about what most likely comes next based on your analysis of market history and the volatility and all the conditions. So somehow, shout out to liberal arts majors, it worked out pretty well. But once I learned about technical analysis and learned about investing, I haven't looked back. It's been an absolute joy.
It's incredible. And I love those metaphors because they tend to make a lot of sense for anybody who's traded the markets, anybody who understands music and all of the different components that are happening at any given time. It's very much like watching a bunch of different indicators and then watching price. And these are all variables that are moving at any given time. Yeah, I absolutely love those metaphors. Did it make a lot of sense to you, the idea of trading and charts, immediately? Did it take some time? And what was your kind of training like at Bloomberg at that time, just coming out of school and kind of getting a whole sense of what the market can offer?
Yes. So the theory at Bloomberg is literally throwing you in the deep end, and your job is to serve as a help desk for institutional investors. And so you learn very quickly from very demanding customers, I'm trying to price this option and it's not working right. And so I would have to, we had sort of a 6-week training on all the different asset classes and analytical styles and how to calculate bond yields and what the Fed does. But in the end, you learned a ton just from hearing what questions the customers would ask, by starting to travel around North America, which is where I started covering. And you would, be in Dallas, Texas, working with a couple equity traders at a buy-side shop, and they'd be like, "Hey, why is RSI doing this? This doesn't make sense." And I'd have to understand it and be able to answer questions. So, at the beginning, you sort of were trained by helping customers figure out these things. And so, I think for me, I immediately learned how much I did not enjoy analyzing companies fundamentally and digging through balance sheets. It just did not bring me a lot of joy and fulfillment. I struggled looking at mortgage vectors and thinking about valuing, asset-backed securities. Did not make sense. Charts made sense. Charts just clicked, and I feel like that's one of those one of those pivotal moments in your career that ends up being very foundational. I remember looking at charts and other people kind of struggled to make sense because they didn't really understand why you would analyze things statistically and try to quantify emotion. And for me, I'm like, this obviously makes sense, right? Stocks should move based on people getting nervous or people getting excited. Like, how could it not be that, right? I mean, this just made so much sense to me, having studied behavioral psychology and other disciplines. So I think for me, I was immediately drawn to that part of it. And then once I was able to focus there, I would say my learning curve accelerated because we actually didn't have a technical analyst in the main New York office there. The guy, Rick Bensignor, had been the technical analyst and had left to run the technical research department at Morgan Stanley. So there was just sort of this opportunity I felt very quickly of, boy, if I studied hard enough and worked really hard, I bet I could become the technical analyst after a period of time. And the good thing was, part of that was being able to talk with people like John Bollinger and Tom DeMark and Connie Brown, who's written a number of books on technical analysis. People like Bob Prechter, who really promoted Elliott wave theory, and being able to work with experts like that. Steve Nissen on candlesticks, we had him in to do some events, so I was able to talk with him about how he thought about candle charting and what specific rules he used. So for me, it was a mix of being able to work with really renowned experts, but then also spending time at hedge funds in Connecticut and trading floors in New York and seeing how guys on the equity desk at UBS would trade stocks using charts. And quickly I picked up on what worked and I saw what didn't work. And for me, as a long-winded answer to your question, Anthony, I think one of the big things for me that I learned in those formative years was the fact that technical analysis is a fabulous way to manage risk. And I feel like too often traders think of technical analysis as the way to hit the next home run, right? The way to find the next thing that's going to be amazing. I found it to be way more valuable for managing risk. And that was because I started studying technical analysis in 2000 and 2001. So as I'm learning about charts, 9/11 is happening, the tech bubble's bursting, the world completely changed in the financial industry. And clients I worked with that navigated those periods well were all chart-related investors that saw clear signs that things were changing and they took action. So to this day, I feel like my work is echoing some of those lessons I learned early on from clients that were able to navigate a challenging period using technical analysis. And for them, it was all about risk management.
That's a great point. I mean, those who understand technical analysis, I think in a lot of ways have an edge. And especially, you're talking about 2001 and 2002. And I remember 2007 and 2008. There was so many people who were on the fundamental side explaining why Bear Stearns or pick your poison at that point this is just a little bit of a sell-off, don't worry about it. Yeah. Whereas the technical analysts and being able to read a chart, I mean, it was, I think in a lot of ways much clearer. The tide had turned. So just to kind of underscore your point there, I think technical analysis over the years has definitely proven itself as being able to help manage risk. Have you seen that, even as the years have went on, just this prominence of technical analysis?
Yeah, I mean, it's changed quite a bit, I feel like, right? Over every generation, I feel like it evolves. And I remember, talking with Ralph Atkampora many times, who's one of my mentors through the CMT Association. I met Ralph early on in my career, and he became just a great mentor about how to approach the markets, how to use discipline, how to not take yourself too seriously. And, talking with him, I mean, his career, he called himself a chartist because most of his time was spent manually updating the charts. He would tell me like 90% of his time was just updating the data because it was so manual. And then the 10% at the end was actually analyzing the charts. I think that the way that we do technical analysis has evolved so aggressively. I think capabilities with AI and other things will continue to evolve the discipline. I don't think that means as a technical analyst, my job goes away. It definitely changes. And so far in pretty good ways. I'm finding it way easier to find interesting charts than it was 20 years ago because there's a lot of ways to automate that. Doesn't seem like a bad thing to me. I think that's pretty powerful. Another big change I would say, Anthony, would be the growth in hedge funds, the growth in behavioral finance as two kind of pivotal evolutions in the financial industry. I remember early on in my career, I was at a hedge fund in New York City, and I went to an account, and I met someone, and he had a PhD in physics. And he was working at a hedge fund. And I remember asking him, I'm like, why are you working here? Like, why aren't you off, teaching in a university? He's like, this is the future. He's like, it's called quantitative investing. It's going to take over everything. And sure enough, I mean, it's amazing how right he was. But, so I think that the fact that so many hedge funds are using technical analysis or price momentum or some sort of model, I think has certainly helped. And behavioral finance, the fact that there's a whole academic discipline that is built on how we make poor decisions and why it's so obvious that we do so, has certainly helped me think about why charting and technical analysis should be such an important part of our toolkit, because we're hardwired to make very bad decisions. So let's use a set of tools to make better decisions. So the industry has definitely evolved over time in a number of ways that I think has made technical analysis more relevant now than probably ever in my career.
If you're looking for ways to take your trading to the next level, Investors Underground might have something to offer. You'll have access to courses and mentors to learn from, some of the best technology available for scanning stocks and breaking news, and access to the chat rooms, where you'll find a vibrant community of focused traders who share their trade ideas in real time each day. Members also have access to the morning broadcasts, where the IU moderators share their trade ideas for the day ahead during the pre-market session. Members have access to the midday study sessions with Stan, the midweek study sessions with Sam, webinars, moderator watch lists, and all the other tools and resources that Investors Underground has to offer. Listeners of The Trader's Journey can access exclusive membership deals available at investorsunderground.com/journey. And now, back to our episode with David Keller. I love the importance of technical analysis. And as you mentioned, even, charting and thinking about it as charting. And one of the things I noticed about you is, in your Chart This podcast, you just go over chart after chart after chart. And it strikes me as amazing because someone with this much experience being able to have this much fun, seemingly, and, correct me if I'm wrong, but it just seems like you have so much fun going through the charts, doing the work.
Yeah.
That's something that you've noticed along your careers, the guys and gals who stick at this, decade after decade. They just have fun with emphasis on the work, going through the
Yeah.
process rather than looking at the end goal. Was it a successful trade? How much did I make? Which is all important in its own way. But I kind of wanted to focus a little bit about, the importance of the work and enjoying
Yeah.
the work.
I'm so glad you pick up on that. Hopefully that the joy I have of analyzing charts comes through in the stuff that I put out. I'm glad if you picked up on that, Anthony. It's so funny story along these lines. My wife and I lived in New York when we were just getting started in the industry. This was like mid 2000s, and I was studying for the CMT exam, which is a professional exam for technical analysts. My wife was studying for her CPA to become an accountant. And every evening we'd sit at the kitchen table together. She would have her books and I would have mine. And I was having an absolute blast. I was loving it. It's like every day I'd be reading John Murphy or Martin Pring or, one of these great, technical analysis authors. I would read something. I'd be looking at charts the next day. I'd use them during the day and I'd trade based on them. I'd be like, oh, that worked. Oh, that didn't work. What happened? And I was just having fun. And my wife was absolutely dreading every moment of it. She was just complaining like, this is dumb. I don't want to do audit. I don't want to do legal stuff. I have to study all this. And it's just, none of it was practical. And it showed me how what we do as technical analysts or as a technically oriented trader, it is a very practical set of tools. And I've always found that to be so refreshing. A big part of what I do is just routines. Doing the same set of things every morning, every weekend, every month as a way of just understanding what's happening in the markets. I still to this day, it's 26 years into this career and I look forward to it like every morning. It's like, wonder what the charts look like, what's changed, oh, this is different. So the life lesson I hope people pick up on is I feel like the financial industry is filled with too many people that did not find something they're passionate about. They found something that they're tied into because of income or status or whatever. I would encourage everyone to find something you're passionate about and find a way to get paid doing that. Life is way better that way.
Absolutely agree. And I definitely want to segue into this idea of your routine and what that looks like, because, my next question was going to be, about your trading style. And part of that is, how do you find, edge in the market? Where do you find edge and what does your routine look like? So if it's okay with you, David, I'd love to go through, sort of what your routine looks like.
For me, I think of what I do in kind of three different buckets. And for me, the important routines are important in that in how you're able to link those routines to the questions you're trying to answer, right, as a trader. So for me, I build my whole routines off of the time frames that are most interesting to me. So I would classify myself as a position trader. I'm usually looking on average, maybe 1 month, 2 months out on average, although I'll do stuff on a tactical time frame, a little shorter, and I'll certainly hold longer term positions if the charts justify it. But at the end of the day, I'm generally a trend follower, because if you're looking out 1 to 2 months, that's where you probably want to be. The data over time would support in the equity markets and most ETFs, you probably want to be following trends on that time frame. In a shorter term time frame, if I'm a swing trader, I want to be betting on mean reversion. And if I'm a really long-term investor, I want to be betting on mean reversion as well. I'm looking at longer term shifts in like the business cycle or the economic cycle. So for me, I'm kind of going on that middle ground. So this is literally the first chart I look at every single day, and I call it my market trend model. It's a weekly chart of the S&P 500, and then it includes 3 different time frames, and it uses a series of exponential moving averages to create this framework. So I'm looking at the 5-week, 13-week, 21-week, and 34-week exponential moving averages. And if you're not a big chart person, if you're watching moving averages are a way of smoothing out the price data. Exponential moving averages just weights the data a little bit differently and weights it more toward the more recent data. So it's a little more sensitive, a little more dynamic, which I found really helpful for trend following. So what I do every day is literally look and say, all right, what is the long-term trend? What is the medium-term trend? What is the short-term trend? And each of these sets of histograms are basically looking at comparisons. If the current price is above the 5-week exponential moving average, I say the short-term trend is bullish. And it turned bullish for me for the S&P mid-April of this year, coming off the April low. The medium-term trend model is looking at a different comparison. Same with the long-term, just longer-term averages. And the medium-term model is kind of my main risk-on, risk-off model. When the medium-term model is bullish, I want to be risk-on. When the medium-term model is bearish, I want to generally be risk-off. And so this is the starting point to my day's work every morning. And the chart does not change much every day. But for me, I found, earlier in my career, I would look at the wrong stuff. I would look at things like, news headlines or, my brokerage account or a portfolio. And what happens if you do that, you immediately get sucked into the flickering ticks, the short-term movements in the market. And if I really want to be more of a position trader, then I have to start my brain. I need to prime myself with, okay, this is where I'm trying to operate. Let me start to gather evidence to validate where I want to be and identify what's working and what's not. So it starts with this chart. It goes to a daily chart of the S&P 500, then probably about 80 some other charts that I go through in order every morning. And I do the same thing. And I will tell you, what I'll tell you about routines. I always tell people that an imperfect but consistent routine is way better than a perfect but inconsistent routine. So strive for consistency. Strive to set a time aside every morning, every week to go through charts, to review market conditions, to understand where you're at. Don't worry about coming up with the perfect, setup. That's something you'll be able to improve on over time. But if you have the perfect set of information to look at, but you don't do it consistently, your returns and your outcomes aren't going to be as consistent either. So this is, the set of charts I look at, I've iterated over time just by trying to keep improving. And if something doesn't work, I get rid of it. And if there's something new, I add it to the list and I just keep rinsing and repeating every day.
I think that's fantastic advice, and especially iterating on what your process is over weeks, months, years, decades. Yeah. One of the things that I noticed, David, for people who are just listening to the podcast, there's a couple other indicators on there. I see RSI, which I tend to use myself. Are there any indicators that I'm missing? And, another way to phrase that might be, what indicators, maybe top 3 or top 5, whichever, makes sense to you, do you tend to prioritize when you're looking at a chart, either for its health, or trend, or to help you get either into a trade or potentially exit a position?
No, that's a really good question, Anthony. So I kind of have a go-to chart. It's my starting point. And then depending on what I see here, there are a bunch of other things I could look at. And I would encourage people, the technical analysis toolkit is pretty broad and pretty diverse and has a lot of stuff. And I would encourage people, as you learn more about technical analysis, at the end of the day, you have to kind of pick your go-to kind of most important indicators. It's very easy to fall into analysis paralysis and just have way too much on a chart. And then it's really hard to come up with any conclusion. So for me, and again, this is just something I've refined over time. And this is a chart of home builders I'm bringing up just as an example. ETF, ITB is the ticker. So I start with moving averages. So I have a 21-day exponential moving average as a short-term measure of movements. I have the 50-day simple moving average, and then the 200-day moving average as a measure of long-term trend. And, making the very quick initial assessment, is the price above or below the 21-day EMA? Is that sloping upwards or downwards? If you just do that basic assessment, you will generally be on the right side of things. You will avoid being on the wrong side of things, right? And generally, I want to own things that are breaking out above their 21-day exponential moving average. I want to not own things that are breaking below there. The 200-day moving average, sort of a longer-term version of that, right? And Paul Tudor Jones famously said, nothing good happens below the 200-day moving average. So one of the classic checks I do on my portfolio is just look for things that have broken below their 200-day moving average and just Am I 100% confident that I still want to own that position if that's where the price has deteriorated? So moving averages are super helpful for me. The slope of the moving average, where the price is relative to the moving average, I think is a great sort of basic assessment of trend. Beyond that, there are other two indicators I have on most charts that I look at, particularly with stocks or ETFs. The second would be RSI, which is a measure of price momentum. That answers the simple question of how has the price gone from point A to point B over a period of time. And it's kind of, if you know statistics, it's kind of like taking a Z-score of the price action. It kind of normalizes the price movements, because what we're trying to do here is just identify extremes. When has the market moved too high too quickly or too low too quickly? And understanding if a stock is overbought or oversold, if there are divergences between price and momentum that tells me maybe we're at a turning point. Those are all really important assessments, I think, to make, to understand kind of where we're at within the normal cycle of price action. And then the last thing I add is relative performance or true relative strength, looking at the ratio of that stock or ETF versus its benchmark. And this is something I learned working for institutional investors when I was at Fidelity for almost 9 years as a director of research. Worked with a lot of money managers. We were all paid based on our ability to outperform a benchmark. So you better believe we kept a very watchful eye on the relative performance of positions we had, because if the relative performance line was going up, we were doing well and we were getting paid. If it was going down, we were struggling. So you would often want to reconsider positions where the stock started to underperform your benchmark. So, looking at the performance of, in this case, home builders versus the S&P, recognizing when that relative performance starts to shift is something I find institutional investors tend to prioritize. Individual investors and traders kind of underweight that in their thinking. And I hope that they are inspired to change that, because it's really helpful to just understand the opportunity cost, right? Am I looking at the right chart at all, right? Generally, I want to be owning things that are outperforming. Otherwise, why are we managing actively at all? So that's my go-to. That's kind of what I start with: moving averages, trend, momentum, relative performance. And then from what I see there, then maybe I dig into volume indicators or other oscillators and other things. There's a lot of other things I can do to kind of further validate what I might see with that initial first look. Does that make sense?
Absolutely. Thank you so much. Yeah, and I think that gives the audience a new indicator that we might not have discussed yet on the show, on the podcast. So yeah, that's great information for the people to consider and look into. This indicator that David's mentioning, which is relative performance. As part of your trading and investing ethos, do you find that you tend to be more on the bullish side of things? Do you ever take short positions? How much of your trades are in maybe individual stocks versus maybe an ETF? How do you kind of balance all of those things out? Is it pure equities, options? Do you mix the two?
Oh, that's like a day-long webinar kind of question right there. That's a good one. That's a good one though. I mean, how do I do it? I mean, I think at the end of the day, for me, it's about finding a structure for my portfolio that makes sense to me. Here's what I've come up with. I kind of go with the core and explore model, right, with my own portfolio. So I have a core position, which is really more automated than anything. I have a momentum model that I started using. It's drawn from some really cool work by Gary Antonacci, who wrote a book called Dual Momentum Investing. Greg Morris, who wrote a book called Investing with the Trend. The Ivy portfolio, which is really kind of classic momentum-based approaches. Looking at a series of ETFs and just thinking, what's working? I want to own that. What's not working? I want to not own that. And every month or however you're rebalancing, you just keep kind of going into it. So I have a core position in my portfolios that's kind of driven by momentum. I try to think as little as possible about that position and just trust that the model overall will work, which it has for over time. But then the explore part of it is where I really am able to take individual positions in ETFs, in individual stocks, when I feel like there's an opportunity. Cryptocurrencies have been certainly a way that I've added a lot of that position in gold that I own right now with GLD and IAU. Those are positions that came because the chart started to look pretty good. And what I've found over my career is a lot of times when a chart has not looked good, like gold, it's kind of been underwhelming. and then just starts to work, people will complain and question that all the way up. And they will talk about why it shouldn't go up and why that obviously isn't right. And my answer is the chart's going up and I want to own things where the chart is going higher, right? So regardless of how important you think Bitcoin is for the future of humanity, if the chart's going up and it looks constructive based on my methodology, those are things I want to own. And I feel like the reasons why that works is going to happen later. So in that exploration point, for me, it's a mix of time frames. I don't short a lot, but I will use like inverse ETFs occasionally as a tactical play. So if I feel like growth stocks are overextended, I would do maybe a short, growth ETF or something like that. I don't use options, and if looking back in my career, it's probably something I could have done differently. My issue is I worked for Bloomberg, which was an options exchange at the time. They had Bloomberg trade books, so we were restricted from trading options. I worked at a big money management firm where I was restricted. So compliance killed the whole way the time when I would have learned options and incorporated them in my process, I couldn't own them. So I've never really added them to my portfolio. I am certainly looking at option strategies as a way of better managing risk, because I think that's something that can be difficult. I think it's something that can be made much more readily accessible using option strategies. So for me, it's pretty plain vanilla. It's mostly on the long side, and it's generally looking for constructive charts and finding things that are starting to improve, stocks that look like they're in an accumulation phase, and just following those trends as long as possible.
How long would you say a position might last? Are you generally interested in holding for a week? Does it just depend on what the price action is looking like? Or how do you think about all of that in terms of the length of a position?
So, so I can tell you on average, positions that I own is probably about a month, I would say. Having said that, I have some positions that I've owned for quite some time that I'm not, Berkshire Hathaway, I've owned that for a while as an individual name. It's not going up at the moment, but overall it's been a great generator of wealth, and I don't think that's changing. And then I have short-term positions as well. So I think one of the great benefits of technical analysis is you're not tied necessarily to a particular time frame, right? If you think about an investment horizon, I think for me, it's about averages. Like what based on my methodology, how often do I tend to hold things? But the good thing about charts is if you take a position and then 3 days later, it doesn't look like a good chart anymore, like you leave. And I think that's one of the great sort of benefits of technical analysis, as we mentioned, trailing stops. And one of the techniques I use is called the chandelier exit system. This is a trailing stop technique that was introduced by Dr. Alexander Elder in one of his books, and it's a trailing stop based on average true range. And not to get too much in the weeds, but ATR is a really good indicator because it basically is just what's the normal range of a stock. And what you want to do with a stop is keep it outside of kind of the normal noise of the markets, but keep it close enough that it triggers when disaster happens. And so for me, when I take a position, I immediately start looking at the chandelier exit and just say, look, if that triggers, doesn't matter how long I was expecting to hold it, like the chart's no longer good, get out. And so I think that's one of the great benefits of charts is using it as a way of recognizing when the conditions have changed, when whatever trade you've planned out, if the chart tells you that's not happening anymore, like get out of the way. And one of the great joys, I think, of an equity investor, there are thousands of stocks I could buy at any given point. So if the chart isn't doing what I want it to, let me find a different one that looks like a better opportunity. And by keeping your losses small, by sticking with your winners, that's a classic way of again, overall surviving different market regimes. That's what I try to do.
And with all of the different types of market cycles over the years, is there one particular trade or set of trades that you think back about and as maybe like a shining example of your trading system or your style, or something that your system helped you, in terms of risk management, get out of when it was time to get out of it?
What's so funny, Anthony, as you started asking that, I immediately think of horrible experience. I'm thinking of like where I totally got it wrong. That's what I immediately go to. Maybe that's my natural pessimism. You asked earlier about like my, your natural approach to it. So the problem I have as an investor is I started learning about the markets in 2000. And so my introduction to investing was hearing a bunch of people that said investing is easy, trading is no problem. I started a Daytech online account, which dates me a little bit, but it was the cheapest way to just access, and trade stocks. And, it was basically trade.com companies because they always go up. And then I watched all of that get absolutely destroyed, in the early days of my career. So I have a problem where I'm sort of naturally cautious. When things go up, I'm ready for them to top out. I'm looking for signs of negativity. And it's helped me to make sure that I'm always focused on risk appropriately. My problem has been at times in my career where I've not recognized how long charts can go up before they stop going up. And that shows you how much, when people are euphoric about a trade, when a trade really gets going, it can go a long way before, that starts to unwind. And to I guess edit your question, I'll tell you one of my the moment I always go back to was in 2013. So if you know your market history, you had the market peaked in 2000, the S&P 500 sold off into a 2002 low, rallied back into a 2007 peak, 0809, you mentioned the housing crisis, financial crisis, we go down. Then we kind of go back higher. In 2012, 2013, we reapproached those highs. And the S&P in 2000, in 2007, in 2013, all about the same level. And I turned super bearish in 2013 because I'm like, all right, I've seen this happen 2 more times. We get to this level, stocks feel overvalued, stocks feel overextended, we're going to turn lower. And I was so negative that the head of the desk at Fidelity, the head of the trading desk, called me Dr. Doom for a while because I was telling him, things are going to go down. And then I watched in horror over the next 3 to 6 months as the market just kept going. And all these things that I was quite sure were going to happen never really materialized. And so for me, from that moment on, I turned into much more of a trend follower, not sort of just selling because things had gone up a lot, but having conviction to unwind positions when I saw signs of distribution, and changing from trying to, predict the future with a crystal ball to just recognizing when things shift. And that sort of mental shift in my own trading has helped me dramatically because it's allowed me to stay bullish in 2021, in 2024, years were all on the way up. You could make arguments as to why stocks shouldn't go higher, but then they just continue to do so. And so using trend following tools, tracking the uptrend, looking for signs of divergences and negativity, but waiting for the validation of the price actually rotating. So I would argue my best trades have come after that experience when I've learned to stick with trends well and then just unwind when the trends are no longer in place. And for me, that's been a great mental shift over time.
Yeah. One of the things that's really incredible listening to that is, everyone brings their biases to the market, but those that tend to stick around, I've noticed, are the ones that are able to adapt and make that switch away from, the Doctor Doom into the Captain Americas, to use an analogy there, right? Is to be able to flip over to take the bullish side if that's what the market is telling you and price action is telling you. And like you mentioned before, the chart's going up. It might be melting up, and seems like it's sort of a paradox of physics to be melting upward, but that's what it's doing. And so can you talk a little bit about the importance of being able and how you do it to actually pull it off, to flip your bias and to be able to make that switch? So I think it's easier said than done.
Yeah, no, it's such a good question. And I will tell you, having worked with a lot of investors and a lot of traders over my career, I mean, institutional traders running $10+ billion funds down to individuals running, small, portfolios in their Robinhood account. The number of zeros doesn't make you immune to these sort of behavioral challenges. I wish I could tell you it does, but I've seen successful money managers struggle with getting out of their own way at times. If there's one thing I found that differentiates sort of novice traders that never really get their feet under them well versus successful traders like Steve Cohen types who have been able to demonstrate their ability to have an edge over time, it's having an honest assessment of what they're good at and what they're not good at, right? Understanding what your strengths are as an investor, as a trader, and even more focused on what your weaknesses are. And this is something I found, at Fidelity and working with large money managers. I found the most successful ones were very open about what they weren't good at. They will tell you where they struggled, but what they did is they didn't ignore it. they embraced it, right? They would find ways to benefit from their strengths, but then surround themselves with resources, with people, with tools to help address their weaknesses. And for me, a lot of the conversations I would have would help them use technical analysis as one of those ways of addressing weaknesses. So, I often find when you think about the life cycle of a trade, the four deadly sins you can make are buying too early, buying too late, selling too early, selling too late, right? Those are the four classic things we can do. I bet in your own trading, you can find one or two of those that you probably tend to do more often. And that will tell you very quickly where your biases are. Classic one is people hold on to things way too long. They sell way too late, right? A position works, they hold on to it. The position no longer works, they still hold on to it. And there are a number of behavioral biases. Why? That's confirmation bias, that's endowment bias, where we have an emotional attachment to the position. But it's really hard. So, using a set of technical tools to help you review your portfolio, your positions, and say, look, if any of my positions XYZ happens on the chart, I want you to pop up with an alert on my cell phone and tell me you're holding one of those things that's starting to look like one of those problem charts. And so I think technical analysis is very, very helpful. And now with the modern age of computing power and AI, there are a ton of ways to automate and have systems that you use do some of that work for you. I use alerts all the time. I set price alerts when something might break out. I focus on alerts when things might break down, particularly in my own portfolio. And I just have systems in place because I have a tendency to hold on to things too long. And so I will have an alert that says, hey, this chart's breaking down. Doesn't matter what you want it to do. Hope is a 4-letter word for investors. The price is starting to go down. So I think it starts with having an honest assessment, an honest conversation with yourself, which if you talk to any therapist, that's probably one of the toughest things we have to do as human beings. But I think for your trading success, it's so vital.
Yeah, absolutely. And one of the hardest things to do, but so much reward at the other end of that, putting in that work. David, in your trading and your investing, how important has things been along the lines of trade reviews, and going through the work of what could I have done better? What does that process look like for you? Is that something you still do? Did you do it early on? Can you talk a little bit about that improvement process?
I actually have my trading journal right here, and
Wow.
I won't zoom in too much. So, but I'll tell you this. So for me, having a trading journal, life changer. And I started this. One of my early mentors told me, like, start writing down everything you do and why. And so for me, for individual trades, I write it down. To be honest, selfishly, one of the great benefits of doing a market recap show every day, which I do, is that it forces me to look at the charts and share with thousands of people, here's what I'm seeing. And I've been wrong plenty of times, and you can go back and it's all time stamped on YouTube, and I can see how wrong I was at different periods. And for me, going back to the April low this year is something I've done, with something I'll do later this year, is look back. All right, how well did I navigate that period? How bullish was I or bearish was I at these pivotal points? Because unless you go back, you're not going to improve your game for the next round. But my trading journal, and again, not to get too specific, but you probably can't see it too much, but every trade I have has 3 lines on it, and I literally to this day handwrite it in the journal. And every trade I say, what am I doing? Why am I doing it? And what would tell me I'm wrong? Those are the 3 lines I write down. So step 1, what am I doing? What position, at what level? Just the specifics of the structure. Line 2, why am I doing it, right? What is the edge? What is the general approach? It's a breakout above this moving average. The RSI did this, whatever it is, just to remind myself, here's what compelled me to take action. But that 3rd line is so important, which is, if I see this happen, then I know I'm wrong and I need to exit. And that is so what you have to, I think, go into a trade, as much as we want to assume we're going to be right all the time, I know better. I know I'm going to be wrong plenty. And so just opening myself up to, I might be wrong, and here's how I will know that that's true. That's what informs my stop strategy, right? That's the stop order that I put in. That's the trigger that I would see that would tell me, okay, whatever I thought was going to happen is not going to happen. So for me, keeping track of that during the trading day is pretty important, but it's only as good as you making time to go back and reflect. So depending on how often you trade, once a quarter is good for a lot of traders. Just go back through your trading journal. What did I get really well? What did I do really well? What were my best trades? You probably already know them. Just review what caused me to have that success, but spend way more of your time on the trades that did not work well. What were some of your worst trades and why? And that's something I learned from my Fidelity days. We would have a like bring your own chart meeting once a quarter, and everyone would have to print out their worst call and go into a conference room. We'd have to sit around the table and explain to everyone else in the room in the technical research department, here was a bonehead mistake I made, and here's why. And it was a humbling but incredibly valuable meeting because it forced you to just come to terms with where you missed something. And we all, I feel like, were able to elevate our game over time by focusing on where we made mistakes and just fixing them as much as we could.
That's incredible. And thank you so much for sharing your trading journal. That's incredible. You actually have a journal that you write the trades down. And I love that. And I think it's important for traders to know that, David's been in this world for, decades at this point and still has a trading journal. So if you're thinking that you've been trading too long to have a trading journal, or you'll start tomorrow, maybe consider what David's saying here. I also think it's really incredible, this idea of bringing in your worst trade into a technical, division and discussing it, because, it's the antithesis of what we tend to see online, which is so much of people flexing their big wins. And anybody who's traded long enough knows that they've gone through a bonehead trade, one that hurts, is embarrassing, that they probably not want to think about again, let alone have to print out and tell everybody else about. I think it's actually a really powerful exercise for people to consider what that trade would be for them, either all time or in the last week or month or quarter. So yeah,
agreed. And even if you never tell another soul, do it for yourself, and you'll find it a very therapeutic experience.
Yeah. Absolutely. And sort of along the lines of kind of like the behavior that we have as traders and investors, I want to talk a little bit about behavioral finance. So for those who are kind of in the dark or wonder what it is, what is behavioral finance?
Yeah, so for years and years, I mean, decades, if not centuries, technical analysts kind of knew that people act irrationally, right? It's obvious on the charts, and you can see when a market becomes overextended. You can see when there's fear or incredible optimism. All of that's reflected in the charts, and I would argue that most of technical analysis is driven by the fact that traders tend to behave very poorly with their capital at times. And so behavioral finance is really an academic discipline which has grown out of Nobel Prize winners like Kahneman, Tversky, Richard Thaler, and others who did some foundational research on how we emotionally and behaviorally connect with the financial markets. Things like how we experience gains, the pains of losses, and how that informs the sort of risk that we're willing to take on. All of those things have been quantified. How investors are truly irrational in their decision making. So what behavioral finance really comes down to, I would argue, is a series of behavioral biases, right, or of cognitive biases, things that we are hardwired to do that unfortunately get in the way of our investing. And I randomly threw out a couple of them earlier, but common ones to think about. And I'm sure as you think about your own process, you'll recognize where this has happened for you. Most common one is confirmation bias. I think social media just amplifies this bias for a lot of traders. Confirmation bias is where you make your decision first, and then you start gathering evidence. I'm bullish on Bitcoin. I'm bearish on Nvidia. I'm bullish on Tesla, whatever it is. Then you start reading or listening to interviews. And what happens is you don't realize you're doing it in that way. But basically, when you're reading articles about Tesla, anything that's bullish on Tesla that supports your, bias, you mentally attribute greater weight to it. And if anything disagrees with your conclusion, you kind of mentally push it away. So what happens is, by gathering evidence, all you're doing is confirming something you were already going to do. You're raising conviction into a decision you're already going to make. What you want to do is, of course, flip that script, right? We want to gather evidence first and then make our decision based on the weight of the evidence. So I always try to coach traders on making an evidence-based process as opposed to an emotion-based process, right? We want to gather evidence and then, based on what we've gathered, determine what positions we should be putting on or taking off. And that unwinds that powerful confirmation bias. And again, social media is a huge problem, because every time you like something or follow someone, you're teaching an algorithm what you want to hear, and then it's just going to give you an echo chamber of things. So my Twitter feed, my X feed, is full with a bunch of growth-oriented, equity, technically oriented investors. So if I'm looking for diverse ideas, I'm not going to find it in my social media platforms. So I think you have to go through that extra effort of doing so. So for me, I think successful trading is about recognizing those behavioral biases like confirmation bias, understanding why they make it difficult to do the right thing with your trades, and then help yourself by developing systems and processes to minimize those. And again, for me, a lot of what I do is coach traders on how to use technical analysis to minimize those behavioral biases, which are so powerful for all of us.
Yeah, absolutely. And every trader that I know at one point or another has discussed a confirmation bias that they've had, or somewhere where they were wrong and they were leaning in a little bit too hard to their own conviction, is a synonym that they might use at the time for why they took that position, and really were slow to cut their losses, or didn't want to see what they were actually seeing, and sort of come to terms with it. So in that vein, along those lines, I wanted to ask, for traders out there who are listening, what's some practical advice for maybe the next trade, for the next day, that they might want to think about, just to be able to apply behavioral finance and sort of some of these concepts to their own trading?
Oh, that's a really good question. I mean, for me, I think honestly, it goes back to routines. I think the reason why I go through the same set of charts every morning in the same order is because I learned a long time ago that if I just start bringing up a brokerage account and just seeing what happens, or bringing up the news and just seeing what's happening, I'm immediately drawn into a certain way of thinking, right? There's a short-termism that happens. Couple different things you could call that. Probably myopic loss aversion, if you want to get technical on it, which is, if you faced with evidence, we tend to get way too short-term, and we are afraid of losing, and that causes us to make bad decisions instead of really thinking about the overall position and what we should own. So for me, going through a set of charts is what helps me kind of orient myself to the evidence. I think what a lot of people do is reverse that, and they think of their own portfolio to start, if that makes sense. So if I look at the markets and think, all right, I have a position in this stock, and I think I'm pretty bullish on how this is going to go. And then you start gathering evidence, like you've already lost, like you've already put yourself in the wrong mindset. So what I want to do is I kind of approach every day as if I'm completely naked, no positions, even though I probably have plenty. It's like I have nothing going on. Let me gather the evidence. Let me see, based on my analysis of the charts, which is obviously the language I use to analyze the markets, what do I think I should be owning and why, right? Where do I see opportunities? Where are the best opportunities, and how should I be positioned? Then I look at my current portfolio, and if they're similar, then I'm in pretty good shape, and maybe I need to make just like some cosmetic tweaks on bet sizing and things like that. But if not, if there's a disagreement, then that's how I know I need to change. So you start with gathering evidence as opposed to, here's my position, what do I do about it? And so I think approaching things that way is super helpful. Another one I would say, and not to get too much down a rabbit hole, is just the importance of bet sizing. I feel like as traders, and certainly as technical analysts, we spend way too much of our time finding the right chart, finding the right stock, the right ETF, the right future, and not enough time thinking of how much risk should I put into this particular position. Institutional investors spend most of their time thinking about potential risks, thinking about bets they're making, thinking about their portfolio attribution, which is basically where are your returns coming from and why. Individual investors just think this is a great stock, I should buy it. And then all of a sudden you take outsized bets, you take super concentrated bets. So for me, one of the ways you, I think, get ahead behaviorally is not weight positions based on your conviction or how excited you are, thinking of it more rationally and thinking about risk and how much you want to allocate to certain things. And then when you're analyzing your portfolio and really going through the day-to-day work, it's less of an emotion-based process of thinking about your best idea and hoping it still works. And it's more just thinking about the risk that you're taking versus the potential returns. And when it no longer looks appropriate, then you unwind the position. So I think that I think for me, routines and bet sizing are two ways to really get ahead of some of the behavioral biases that if you just kind of do it, you just kind of do it haphazardly, it all goes away, and behavioral biases will eat your lunch very quickly.
I think that's incredible advice and great, concept for traders to think about, whether or not they're making some of these kind of inherent, biases, or what their routine looks like and what their bet sizing looks like as well. All things that they need to consider. So thank you so much, David. And I also wanted to talk a little bit about market misbehavior, because,
Yeah.
and to back up a little bit, you mentioned being able to, get away from some of the bias that comes from whatever the algorithm is feeding you online. And so being able to get more of a diverse set of opinions or thoughts, it made me think about market misbehavior, not just necessarily the community, but also the podcast itself, where, you're opening yourself up to a range of, ideas, criticisms at times, I'm sure, and all sorts of other feedback from traders and people along those lines. So can you talk a little bit about what inspired you to start Market Misbehavior, not just the community, but the podcast, and to share your knowledge with others?
Yeah, no, you're kind of asking about that, Anthony. It's funny, for much of my career, really from 2000 to 2016, I worked for big financial institutions where the compliance department would laugh if you wanted to even, hey, I want to go speak at an event. It was like, right, we have to go through all these steps just to get like, what are you going to say? Let me see your slide deck. Like, it was very rigid. So the moment I left Fidelity and did not have a compliance department anymore, after spending some time just trying to figure out what I wanted to do with myself and just sort of, just taking some personal time, I realized how much I just enjoyed looking at the markets, talking about the markets, having conversations about it. Those were my favorite days at Fidelity, was when I'd go into a portfolio manager's office and we would just talk about the markets and what we saw and what we liked and what we didn't and why. And then we'd be able to go back a month later and say, hey, remember we talked about that? How did that go? What changed? And so I started, writing about the markets, and I had a couple people in my network who wrote for stockcharts.com and invited me, basically connected me with the team there when I was invited to start a blog. And I did it, and I absolutely loved it. I'd never really written about the financial markets much at all. I think I'd once moderated a panel before, but I hadn't really interviewed anyone ever before. I had done a lot of public speaking, and I knew I enjoyed that. And once I realized that I could build a business around the things that I really enjoyed doing and not around the things I did not enjoy doing, which was like budgeting and, strategic planning for a research division, not as joyous for me. So I basically created Market Misbehavior and the formal name Sierra Alpha Research, which is, basically an aviation term, Sierra Alpha, for situational awareness. My goal was to help investors and traders just improve their market awareness by using the tools that I'd become familiar with. So for me, I started doing a blog. I turned that into, coming on as a guest on a YouTube channel, Stock Charts TV. I started my own YouTube channel because I was having so much fun with it, learned about video production, and then just haven't looked back. And I've been doing a daily market recap show off and on for probably 5 years now, almost 6 years. And there was a stretch when I stopped doing it and I missed it so much. For me, it's become really a part of my process. And what I find is from the beginning of the day when I do my morning coffee routine, I'm looking at a bunch of charts and I immediately start thinking, this is kind of the story of this trading session today. This is part of what I think helps you understand it. And I put them on a chart list in my stock charts login. And at the end of the day, I'm ready to do a market recap show at 2 p.m. local time for me in Seattle. And I've got a bunch of charts to talk about. And I literally just review, here's what I've been seeing, here's what I've been thinking about, here's what's important to me. So I just took a vacation last week and didn't do a show very often. I missed it. I was excited to come back on Monday and do a show again. So it's really become part of what I do. And launching a podcast, doing interviews and all of that, just really, for me, it's the really joyful part about analyzing the markets, helping other people recognize what they can do to improve on their process. And the most rewarding thing has been comments that I get on my market recap show, people saying, hey, this has helped me think about the markets in a different way. Hey, I realized this issue I was having. And again, I think the community aspect of what we do is super rewarding. So I'm thankful that I get to do it and somehow get paid for it. I'm a fan.
Yeah, and you do such an incredible job. I love watching, both of your shows. Every chance I can tune in, I do so. So thank you for doing that. You're teaching a lot of people about, your expertise and things that you've learned throughout your career. So thank you for that. One question I have, if it's okay, David, is to flip the script a little bit. You're teaching so many people, have you learned anything in particular from the interviews that you've done and people that you've got to talk to, who have been doing this longer than you, or people maybe even who haven't been doing this for too long, that has been insightful for you?
For me, I've learned so much from people that trade other asset classes that I don't trade. I've learned a ton about volatility from options traders, right? And I remember thinking that trading options, I didn't realize how much you would be focusing on volatility and focusing on opportunity and how that changes. And then all of a sudden you talk to options traders, you learn about the Greeks and you learn about time decay and you learn about different exotic option structures and what bets you're trying to make. And so I've learned a ton from, interviewing options traders about just how they approach the world and think about volatility as an opportunity set, which is really helpful. I've learned a ton from, people trading currencies about global investing and about interest rate differential, the relationship between interest rates in different economies, and just opening up your mind outside of that. I feel like so many times as traders, you have blinders on that specific thing that you're trading, right? I trade the Russell E-minis and that's it. And I just need to focus on that. You will learn a ton from talking with people who trade, Euro Yen cross, because they're looking at things. They're looking at behavior. They're looking at extremes. They're looking at mean reversion. They're just looking at different data, but they're trying to answer a lot of the same questions. So I've learned a ton from that. Probably the biggest takeaway I've learned is just how any successful investor has had a lot of really painful, challenging experiences on their way. I interviewed George Noble, about a month ago on my podcast. The legendary hedge fund manager, one of the first international portfolio managers at Fidelity. His career is filled with big misses, things that he struggled with and that he learned from. And for me, it's very easy to just think that your experience as a trader is unique. I messed up and that means I'm not good at it. The best traders have had some of the most colossal failures, and you think of those as growing opportunities. And so I feel like for me, recognizing that being a trader, being an investor is a lifelong learning experience. There's not some point where you have it figured out and you're done learning. People I work with that are successful investors for decades are still learning, actively learning today and trying to learn from misses and learn from wins. And so, I feel like always being a student of the markets, that's probably been the biggest takeaway I've had. The best investors I've worked with still treat what they do as an educational process. And that's what I try to do every day too.
Thank you. And I think that's a helpful answer, because everybody, I think, who's traded has had those misses or a big loss. And, there's still so much room to improve. Even if you're a great trader, there's still so much room to improve. Granted, you allow yourself, as you mentioned, to keep an open mind and to keep learning from others, like options traders, if you don't trade options. So I think that's extremely helpful that answer. So thank you for that, David.
For sure.
David, if it's okay with you, I'd love to end our incredible episode with a lightning round set of questions, pretty quick questions,
Ooh,
pretty quick answers. Is that okay?
let's do it.
The first question would be, what do you consider to be your greatest strength as a trader or investor?
Ooh, open-mindedness. I found, for me early in my career, I was forced to learn every technical indicator on the Bloomberg platform because I was trying to sell Bloomberg to people. And so I've always approached investing, not that I have all the answers, but that there are always other questions to ask. So keeping an open mind to things that you may not be familiar with and considering them, super important to me.
If you can go back to the start of your trading and give yourself one piece of advice that you know now, what piece of advice would you give yourself, and would you have listened to it?
I mean, probably not is the answer to your second question. I doubt I would have. What would I tell myself? I mean, for me, I think the biggest thing I would tell myself is remember that the most painful, protracted bear markets are going to create legendary buying opportunities. And, going through the 2001, 2002 sell-off, 2008, 2009, even more recently in early 2025, it is so easy to get way too negative when things start rolling over. If you look back in market history, the markets have recovered 100% from every correction in history, right? So not being afraid to take positions in a period of severe weakness. I wish I would. I often find myself waiting way too long to believe again, and I should think of that more on the way down. So I would try to, I don't know if I would listen to that advice, but that's the advice I would give myself.
Is there one piece of your trading that you're still working to improve on in 2025?
Ooh, that is an awesome question. I think including options in my process. I mean, for me, the biggest issue I have is I've found a set of tools and techniques that work. I use ETFs and some equities, and it kind of works for me. I would love to diversify more, particularly hedging positions. That's something I don't tend to do well. I tend to think a little too oversimplified in terms of taking on risk, and I bet I could mitigate that risk better using options. That's on my list. I talked with Larry McMillan about this probably 15 years ago, and I'm still waiting for that to actually happen, but maybe this is the year.
For anyone who's considering the chartered market technician designation, what advice would you give them?
Oh, definitely do it. I mean, for me, going through the CMT process gave me a very structured way of considering different parts of the technical toolkit. I learned a lot about indicators like Elliott wave that I realized are not important to my process. I learned techniques like point and figure charting, which I'd never used before, that I realized were incredibly meaningful at times in my career. But I definitely came out of it with a much more structured, consistent process of analyzing charts. Looking back pre-CMT, my process was more haphazard, and I feel like the wins I had were more by accident and less because I had a really thought out process. So I think a big win in terms of helping you formalize how you think of the markets technically. I'm a huge fan.
Is there one maybe book or other resource that you think has been instrumental above all others when you look back at your trading career in terms of influence on you and what you do on a daily basis?
Oh, just one. That's brutal. I have many. What would I say? What's one book? Okay, so I'll pick one that probably no other guest has probably said. The Dow Jones Averages by Bennett Goodspeed. It's probably out of print by now, but this is a book that we passed around Fidelity back in the day, and it talks about what they call whole-brained investing. They argue that a lot of times, if you're more naturally left-brained, right, which is more detail-oriented, in the weeds, or more right-brained and creative, that's going to create some deficits in your process. And if, in the financial industry, a left-brained analyst is really good at digging into balance sheets and income statements, but very bad at understanding the overall portfolio and the bets you're making. a right-brained investor is a really good portfolio manager and risk manager, but very poor at understanding specifics. And you need to use both in a thoughtful way. That book helped me understand that in a way and helped me realize why certain investors and certain traders struggle a lot more than they need to, because they don't recognize how you need to use both sides of your thinking, macro and micro, and relating the two meaningfully. So I would say that one.
If you had to use either flying or playing music as a metaphor for trading, how would you use it and incorporate it? How are they alike?
These are brutal questions that forcing me to choose, Anthony. Because both those are two things I'm super passionate about. I'll talk about flying only because we haven't talked much about it yet. I mean, for me, it provides such a perfect analogy, and the logo of my firm has a little blue Cessna, and the logo of my podcast, same thing. That was all by design. Because when I was learning about flying, I was taking flight lessons outside of Boston. And my flight instructor, it turns out, was a day trader. And when he wasn't teaching people how to fly, he was day trading stocks from the hangar. And once we realized we had a mutual interest in the markets, we immediately started to see the similarities between what you do in the plane and what you're trying to do with stocks and ETFs. And I think the biggest way of thinking about it are checklists, right? Everything you do in a plane has a checklist, from starting the engine to risk management. The engine cuts out, everything has a checklist. And you learn that by following those, you minimize potential problems in the air when they can be pretty disastrous. And I feel like too many traders basically try to fly their airplane without a checklist. I would encourage you to think about the steps that you should be taking for every decision you make. Much better, more thoughtful way of approaching things.
That's a tremendous answer. And last question, David. For those listening and watching who would love to learn more about you or possibly even contact you, how can they do so?
No, thanks so much, Anthony. This has been a blast. You have some great interviewer and great questions, and I appreciate it. Yeah, my website's marketmisbehavior.com. You can find all the stuff I'm doing there. My market recap show, my podcast, blog, all of that's there. And then on social media, X is where I'm most active, and I'm at Keller CMT. So yeah, follow me there and reach out that way.
David, thank you so much for joining me today and sharing your wisdom and your trading journey with our audience. And I just want to echo that if you haven't followed David on X/Twitter or YouTube, I highly recommend you go and you do so now. David, thank you so much again for joining me for this episode. It's been an honor.
No, it was a pleasure, Anthony. Thanks so much.
We hope you enjoyed this episode of The Trader's Journey. We have additional episodes we believe you might also like, so don't forget to subscribe. You'll be notified of upcoming releases the moment they're available. Thanks for tuning in.